There is one ETF that is outperforming both the S&P 500 and QQQ, and that is SPMO. Unlike the ARK ETFs that only outperform for a short while and crash 18 levels underground, SPMO has consistently outperformed, whether it's year to date, 1 year, 3 year or 5 year period. And even though it underperformed the QQQ over the 10-year period, it is already catching up fast. So much so that it has even gotten a 5-star rating from Morningstar. In this video, I'll be going through everything you need to know about SPMO. What is it? How is it able to deliver such high returns? And more importantly, what are the hidden risks of this ETF? Alright, let's go over the basics first. The full name of this ETF is Invesco S&P 500 Momentum ETF. This is a passive ETF, so it has a very low expense ratio of 0.13%. In fact, its expense ratio is even lower than QQQ and QQQM. This ETF has 100 holdings, and looking at its top holdings, you will see many familiar names such as Nvidia, Meta, Amazon, and so on. As its name suggests, SPMO tracks the S&P 500 Momentum Index. What this means is that its holdings are weighted not just by the market cap, but also something called Momentum Score. What is that? Quick pause. If you are looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry, at just 35 cents per trade on the US stock market. It also offers Ireland domiciled ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. Those who study physics will know that the heavier the object is and the faster it goes, the bigger its momentum. Or in other words, how much something has when it's moving. But here's a more official explanation of how this works. First, they will calculate the momentum value of all the holdings in the S&P 500. The momentum value is defined as how much the stock price changed over the last 12 months, excluding the most recent month. Here's an example to help you better visualize this. So they will measure the price change from month 0 to month 11 and ignore the most recent month. They do this to filter out any short-term volatility while focusing on the longer-term trend. Then they take it one step further by factoring in the volatility of the stock. Basically, if a stock has a positive price change, a lower volatility improves the momentum value. For example, even though both the green stock and the orange stock went up by the same amount, the green stock just steadily went up while the orange stock zigzag went up. Because of that, the green stock has lower volatility and will have a higher momentum value as compared to the orange stock. Conversely, if a stock has a negative price change, a higher volatility would have a higher momentum value. For example, the green stock here that just gone all the way down will end up with a lower score as compared to the orange stock that zigzag downwards. Once they have calculated the momentum scores, they will take the top 100 stocks with the highest momentum scores and put them into the momentum index. Each holding will then be capped at either 9% of the overall index or 3 times of its market cap, whichever is lower. And that is SPMO's strategy. To put it simply, SPMO is an ETF that's designed to tilt towards the winners. The faster the stock goes up over the past 1 year, the bigger its weight in the ETF. This is opposed to the S&P 500 or QQQ, which simply holds the stocks based on their market cap and doesn't care whether the stock has been going up or down recently. Now, here's something interesting. If you compare the 5-year performance of SPMO against S&P 500 and QQQ, you will notice that during the first 3 years, all 3 ETFs were giving around the same returns. But during the start of 2024, SPMO suddenly rocketed upwards and overtook everyone. And it's no coincidence that its popularity also started to rise around that time. So, what happened around that period that caused SPMO to suddenly perform so well? The short answer is momentum. So at the end of 2022, the Magnificent 7 stocks began to deliver huge return to the point where they were responsible for around 85% of the S&P 500's total gains. However, at that time, these Mag 7 stocks weren't in the SPMO ETF yet, because remember, SPMO ranks stocks based on their momentum over the past 12 months. Instead, during that time, SPMO's top holdings were the most resilient performers from 2022. These included energy giants like ExxonMobil, Chevron, and ConocoPhillips, healthcare firms such as Merck & Co, and Eli & Lilly, as well as communication companies like T-Mobile. These are the kinds of companies that tend to hold out well during market downturns due to their defensive business models and steady demand. Because of that, SPMO lagged behind the S&P 500 and QQQ during the first 3 quarters of 2023. It wasn't until September 2023, roughly 1 year after the Mag 7 stocks began their run, that SPMO started rotating into them. That's where the ETF's momentum score began to favor these high-performing tech names. Once these names were added in, SPMO started going to the moon. Plus, what also greatly helped was that the Magnificent 7 continued to do well throughout 2024. And even though the Mag 7 saw a dip in early 2025, many of them are now showing signs of strength again, which could further support SPMO's strong upward momentum. Which then brings us to an important question. If SPMO performs well in an uptrending market, how well can it hold up during a downtrend then? If we look at 2022, when the market wasn't doing so well, SPMO was actually more resilient than the S&P 500 and QQQ, both of which fell by 17% and 33% respectively, while SPMO only fell by 12%. So doesn't this mean that SPMO is the perfect ETF, given that it's not only able to give higher returns when markets are doing well, but it's also a lot more resilient when markets are doing badly? Well, not quite. That's because I'm just cherry picking the data. If we change the time period a little, you can see that SPMO underperformed S&P 500 during this period. And even though it didn't fall as hard as QQQ, it was mostly by luck. That's because it just so happens that in the late 2021, SPMO was holding stocks that did well in 2020, which many of them weren't big tech names. Because of that, SPMO was able to avoid falling hard, while QQQ did badly during that period. But if the same crash happened today, then SPMO, which is currently very tech heavy, would fall as hard as QQQ, if not even harder, due to its larger concentration at the top. So, is SPMO a good ETF to invest in? The answer really depends on the market cycle we are in, because the momentum strategy doesn't do well all the time. If the market is in an expansion phase, like what we are experiencing now, then the momentum strategy would perform well, as it captures the strongest performing stocks during bullish trends. However, if the economy enters a slowdown or recession, then momentum can struggle. In such periods, factors like minimum volatility and quality typically hold up better as investors gravitate towards more defensive and stable companies. On the other hand, during the early stages of recovery, it is usually value stocks and small caps that lead the rebound, as they have often been beaten down the most and stand to benefit the most from renewed growth optimism. Here, we have a real-world example of this happening. You can see that the momentum strategy, highlighted in dark blue, only does well when the market is in the expansion phase, such as during 1999, 2005, 2007, and so on. Then, when there's any downturn, the momentum strategy would perform poorly, such as in 2000, 2001, and 2009. But then, given that the S&P 500 tends to go up over time, wouldn't the momentum strategy outperform in the long run as it constantly rotates into the winners? Actually, yes, it does. For example, from 1997 to 2017, the momentum strategy significantly outperformed all the other strategies. But there's a catch. I'm cherry picking the time frame again. The reason momentum did so well during that period was because of the strong bull market that began in 2009, which gave a major boost to momentum stocks. Now, if we have shifted the starting point to just a few years earlier to 1994, the picture changes. In this case, the momentum strategy would not have done as well. Instead, it was the quality strategy that came out on top. Though, that doesn't mean that the momentum strategy is bad or unreliable. In fact, whether you look at the period starting from 1994 or 1997 or even as far back as 1926, the momentum strategy has consistently outperformed both the broad US equity markets and the MSCI World Index over the long term. Okay, here are my thoughts. If you ask me, I do believe that the momentum strategy can be a solid long-term investment as long as the broader market continues its long-term uptrend. However, given that we can't predict where the market is headed next, a more prudent approach would be to use the core satellite strategy. So instead of selling all your existing investments and going all in into SPMO, it might make more sense to keep your broad-based holdings like the S&P 500 or an all-world ETF as your core position. Then allocate a smaller portion of your portfolio to SPMO as a satellite. That way, you get the best of both worlds. Your core gives you steady, diversified exposure to the overall market, while SPMO gives you the opportunity to capture higher returns if momentum continues to outperform. Doing so will allow you to benefit from the upside of the momentum factor without exposing yourself to its short-term risks. But more importantly, it will give you the psychological comfort to stay invested through different market conditions because your entire portfolio isn't just riding on one strategy. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every week.